Warm greetings to everyone. I am Ms. Rupashree, working as Assistant Professor in the Department of Professional Management Studies. So today in our discussion, we will be running through the topic called Income from Capital Gain, which is a part of the direct taxation for BCom and BBA students. So before we move on to the discussion, we will try and understand why study income from capital gain. The first and the predominant reason why we should study income from capital gain or understand this topic called capital gain is because of the tax implications that every country has. Capital gains are subject to tax, meaning any property that we own are subject to tax whenever you buy or sell it. Therefore, it is very important that we understand the tax implications behind buying any financial or non-financial asset. Secondly, in order to do any investment decisions, understanding capital gain becomes very essential in order to predict the potential returns that an individual makes before buying or selling an asset, in order to manage the risk, and also to determine the best time to buy or sell the asset with implications to tax and other procedures. So with this as the base, we will quickly move on and understand what do you mean by a capital asset so that we relate capital asset to capital gain. When you talk about capital asset, it is any kind of a property which is held by an assessee, the person who is going to pay tax, whether it is connected with his or her business or profession. Now, when I say property or a capital asset, it could be a property that is movable, immovable, tangible, intangible, or an asset that can be circulated. For example, a capital asset could be a land, could be a building, it could be any kind of financial assets in the form of stocks, bonds, mutual funds, or any kind of art or paintings that you have bought and kept it with you for a longer time, any kind of patents that the company or the business owns, any kind of goodwill, etc. So these are summarized to be capital asset according to Income Tax Act 1961. Moving further, with regard to capital asset, we will try and understand what do you mean by capital gain. Now, whenever I have a capital asset with me as an individual and I try to sell or transfer this capital asset to someone else for a particular consideration or for a particular amount, then the amount that I receive by selling these capital assets are called as capital gain. Now, in order to determine a particular asset to be a capital gain, according to Income Tax Act 1961, we need to satisfy the following conditions. The first and the foremost condition for capital gain being that there should be a capital asset. The asset, as we have discussed earlier, could be a movable asset or a immovable asset or a fixed or a floating assets. The second condition is that the asset must have been transferred by the assessee. For example, if I am the person who is selling or transferring the asset to someone else during this year, I, being an assessee who is liable to pay tax, must transfer the capital asset to someone else. So that is the second condition for claiming an asset to be a capital gain. The third important condition for claiming an asset to be a capital gain is that the transfer should have taken place during the previous year. So when I say the previous year, it means the year in which you have earned a particular income. So the transfer of the property should have been taken place during the previous year. And the last and the most important condition is that when I am transferring such capital asset, I should have incurred any kind of profit or gain, and the exemptions under section 54 should not be applicable. Or if I have to reduce my taxation part by selling an asset, I should have invested the gain that I've received by selling these capital assets under different sections as given by the Income Tax Act under section 54 and its subcategories. So if I try to invest my gain amount by selling a particular property into different sections of section 54 and its subcategories, I get certain exemptions from tax. So this is about capital gain, where I try to satisfy or meet all these conditions. So if the above four conditions that are listed are met and satisfied, then a person is said to pay tax under income from capital gain. Now, moving further, we will try and understand what are the types of capital gain that could arise. Now, predominantly, capital gains can be divided into two major classifications. The first one is called as short-term capital gain, and the second one is called as long-term capital gain. Now, under short-term capital gain, it depends on what kind of asset you are selling and what kind of asset you are holding for a particular period of time. Now, under the category given there, under each of the short-term and long-term capital gain, we further classify the asset into two categories, namely financial assets and non-financial assets, or otherwise called other financial assets. Now, what kind of assets could be financial in nature is a question. Now, to answer that question, any assets that are bought and sold in the stock markets like shares, debentures, bonds, or any units of mutual funds could be classified as financial assets. So, in the case of financial asset, if you buy and hold the financial asset for a period of less than 12 months, that is a year, then you call it to be a short-term capital asset. Similarly, if you buy any share, debenture, bond, or a unit of mutual fund and keep it with you for a period of more than 12 months or a year, then you classify the asset as long-term capital asset. Now, we will try understanding what do you mean by non-financial assets. So, non-financial assets are those assets that do not fall under the category of financial assets. Namely, it could be a movable property or a immovable property. Let's take an example. Let's say a land, a building, a jewelry, a art piece. Of such categories come under non-financial assets. So, in case of non-financial assets, if you have bought a non-financial asset and kept it with you for a period of less than 24 months with effect to 23/7/2024, then it is considered to be short-term capital asset, wherein if you buy the asset and hold it for a period of more than 24 months, then you call it to be a long-term financial asset. So, with this classification, we get to know whether the asset becomes financial in nature or non-financial in nature. The moment you understand the asset is financial and non-financial, depending upon the duration, we determine the asset to be short-term or long-term. Moving further, we will try and understand how do you compute the taxability of these short-term and long-term capital assets when it is bought and sold. First, we will look into the format for computation of short-term capital gain, meaning if it is a financial asset which is bought and sold within a period of 1 year, and if it is a non-financial asset, an asset which is bought and sold for more than 24 months or 36 months with effect to the date mentioned earlier. Now, in case of short-term capital gain, this is the procedure that we would be following, wherein we have the sale consideration amount, that is the amount for which the asset was sold for, minus any selling expenses that was incurred during selling a particular property. So, it could be brokerage, or it could be an advertisement charge, or it could be a commission that is being paid in order to sell your property. Now, when I minus the selling expense from the sale consideration, I arrive at net sale consideration. Once net sale consideration is arrived, I give two deductions, namely cost of acquisition. So, what is cost of acquisition? It is the cost for which you have purchased the property for during the year in which you have purchased it. And then after that, we deduct any cost of improvements. Now, cost of improvements is mostly applicable for non-financial assets. Let's take an example of building. Let's suppose I do a repair work for the building that I already own, or I construct a new floor, or I renovate my house. All these are called as cost of improvements. So, once I deduct these two costs, namely cost of acquisition and cost of improvement, from the net sale consideration, I arrive at my short-term capital gain. Once short-term capital gain is arised, if you have invested the gain amount into some other properties or assets, as mentioned under Section 54 of the Income Tax Act, I get to claim exemptions. And the remaining amount would be my taxable income from short-term capital gain. So, this is the format that we would be following for computing the short-term capital gain arised by an assessee or an individual. Next, we will be looking into how do you calculate long-term capital gain. Now, when you compare the format of short-term and long-term capital gain, it's almost the same, wherein in case of long-term capital gain, after arriving at net sale consideration, we give indexed cost of acquisition as one of the deduction and indexed cost of improvement as another deduction. Now, when you compare these two formats, in case of short-term capital gain, the amount to be deducted is just the cost of acquisition and just the cost of improvement. Wherein in case of long-term capital gain, we deduct indexed cost of acquisition and indexed cost of improvement. The meaning of acquisition and improvement remains the same as we have seen for short-term capital gain. But why is the word indexation attached in case of long-term capital gain? Is because these are assets that were held by the assessee for a longer period of time, let's say for more than a year in case of financial assets and more than a year, more than 24 months in case of long-term financial assets. In that case, why is indexation given? Is in order to equate the cost to its present value. According to the Cost Inflation Index of India, every year the CII values are being computed and we try to equate the cost of acquisition which was purchased long period ago to the present value of money. So therefore, indexation values are added in case of long-term capital gain but not in short-term capital gain. So once you deduct the indexed cost of acquisition and indexed cost of improvement, you arrive at long-term capital gain. After which, if you have invested your money into any other kind of new assets or in order to buy a new kind of a property or any other capital asset, you get to claim deductions under section 54 and its subcategories as mentioned, and the remaining balance, if is there, it will be called as long-term capital gain. So these are the predominant formats that are to be followed in order to compute a short-term capital gain and a long-term capital gain. Please remember that indexed value or indexation value, that is cost inflation index, is computed only for long-term capital gains. It could be financial asset or a non-financial asset in nature. Wherein for short-term capital gains or short-term capital assets, we do not have any CII values or cost inflation values to be given. So with this, we will just take a quick recap on what we have learnt in today's discussion. First, we saw what is capital asset, and then moving further, we saw what do you mean by capital gain as per Income Tax Act 1961. And we also saw the 4 conditions that are important for computation of capital asset or to call a particular asset to be a capital gain. Further, we also saw what are the types of capital gain, classifying them into short-term and long-term as well as financial and non-financial asset. Moving further, we saw what is a format that is to be followed in order to compute short-term capital gain and long-term capital gain. So by this, we come to the end of our presentation. Thank you for your patient listening and watching. We will meet up in our next video where we will see an example of computing short-term capital gain and long-term